Last year, the excess and surplus line segment notched its highest level of annual premium growth in 17 years. This may not come as a total surprise to those who follow this market closely. While the COVID-19 pandemic presented challenges for the overall insurance industry, it presented opportunity for surplus lines writers. I'm John Weber for AM Best TV. We're joined by two AM Best analysts, Director Robert Raber and Associate Director David Blades. The two helped author AM Best Annual State of the Market Report. David, we're going to start with you. So what's behind the significant premium growth in the E&S market in 2020?
Well, I think there are a couple of different factors that really drove that growth, John. Coming into the year, so coming into 2020 and even pre-pandemic, the market had been hardening. It wasn't yet a hard market, although there were some lines, professional liability being one of them in particular, where you saw hardening market conditions really taking hold. And I think what we saw overall was that, especially for specialty commercial risks, the opportunities to sort of ride that momentum really presented opportunities for surplus lines companies, especially as standard market companies began to pull back from borderline surplus lines risks and really focusing on their core business. That gave opportunities for surplus lines companies that really were able to develop the solutions and have the products and bring them to the marketplace quickly enough, working with their wholesalers to really seize opportunities in the market. So I think that market momentum coming in was definitely one thing. And then, sort of part and parcel to that, we heard from a lot of our rated companies that just the volume of submissions that they were receiving from their wholesale distribution partners was really giving them, again, opportunities to pick and choose the risks that fit their risk appetite. And again, I think those factors really drove the marketplace from a premium standpoint. And like I said, there were certain lines of business and certain risk classes where you saw rate momentum also helped propel the overall surplus lines premium.
From an operating standpoint, David, how did the market perform compared to the admitted market?
Well, I think that the surplus lines market in aggregate performed well. It was probably trailed the overall total property casualty market slightly in terms of some of the key metrics like net loss and loss adjustment expense ratio, the combined ratio, and even the overall operating ratio. But if you look from, let's say the last 10 years, definitely the surplus lines market in general has generated better operating returns than the total or the broad PC market. What we've seen in the last few years, particularly those years 2017, 2018, and 2020 that were impacted by natural catastrophes, by wildfires, hurricanes, even convective storms, meaning tornadoes, hailstorms, and things of that nature. Those years that were more definitively impacted by those types of events, that had a little bit more of an impact on the surplus lines market than on the standard market, just because some of the surplus lines companies are providing coverage for those risks that might be a little bit more exposed to some of those perils. But in general, the surplus lines market has performed pretty admirably, and like I said, in 2020 it was pretty much right there, just slightly trailing the broad PC market.
The report notes that surplus and specialty line writers reported being flooded with submissions through the third quarter of 2021. Robert, what's driving this interest?
Yeah, so John, there's two primary reasons for this. The reopening and reestablishment of the economy, and also the continuation of standard market companies visiting their risk appetites. Historically, strong economic activity has been a contributing factor for submissions to surplus lines carriers, especially for new and unique risks. As economic activity has resumed across the country, and as consumers and businesses return to spending and continue to spend, businesses that successfully adapted during pandemic conditions are seeing activity return to somewhat of a normalized level, and some are even seeing increased levels of business. And that benefits the surplus lines companies as those businesses continue to need and looking forward, continue to grow their needs for insurance. What we also recognize is there's some new businesses that were created during the pandemic conditions, falling right into that new and unique risk that surplus lines companies have specialized in for many years. And all of this leads to increases in renewals, increases in new business, and greater expanded coverages, which contributes to the elevating amount of submissions. The other thing that we've seen, and it's been going on for probably about 3 to 4 years now, is how standard carriers are restricting their appetite for certain risks and classes of business. We see AM Best is seeing across the spectrum of carriers by size or jurisdictional lines of business, or even some surplus lines carriers looking at greater levels of risk selection so that their underwriting performance will improve. And this has been going on, as I said, 3 going on 4 years now. So that contraction in the admitted carriers' appetite and that revisiting by surplus lines carriers does put a fair amount of accounts into the market. And the surplus lines carriers who are writing that business, as they've historically done, devise custom contract terms at appropriate premium levels, and that creates an additional level of activity leading to the increases in submissions. And it'll be very interesting for us to see the final numbers that come through for the third quarter, the level of premium and contract submissions that come through the surplus line stamping offices. And we're kind of expecting this trend is going to continue through the year end of 2021 and probably into 2022.
Robert, are there COVID-19 related challenges still facing the E&S industry?
I think the big COVID-19 related challenge for excess and surplus lines is how there might be changes in the economic activity that's been driving some of the success that they've had. If there's a slowdown in activity, it levels off or reverts back to levels seen early in the pandemic. It's going to slow down that need for the coverages that surplus lines companies provide, reduce some of the premium levels, and maybe counter the effect that I was just talking about with the growth in submissions. In general, for the industry, though, there's a handful of concerns that we're seeing. Inflation trends and supply chain interruptions, those impact not just the cost of the claims that companies are paying, but also the expenses of operating the insurance organizations. Long-term volatility in investment market that could derail operating earnings for insurance companies. We're seeing that travel is still somewhat limited. In-person contact hasn't really returned yet. That dampens client interactions. And the surplus lines area is definitely a part of the industry that relies heavily on that interaction between client, wholesaler, and insurance carrier. And of course, there's the virus itself, infection rates, potential mutations, how to prevent the further spread, and as always, the discussion around vaccination rates. So I see those as the challenges that really are facing the E&S industry as the COVID-19 pandemic continues. But with all of that, if you kind of look back to look forward, the E&S industry has already proven itself resilient during the pandemic situation. There was a brief period early when the segment had to adapt to the environment of social distancing, remote work, using technologies to support operations, probably about 60 or 90 days for surplus lines intermediaries and companies to adapt. And they were able to, once past that period, continue to provide the services they need for their clients. And with that ability to continue to provide unique, new, and high capacity risks, the need for surplus lines coverage remains strong. And in most and almost all cases, surplus lines companies were able to meet those needs with little or no concern to their clients. But there's also been other benefits. Reduced exposures have provided relief to loss experience. Most E&S companies did not have exposure to business interruption losses. They're a little shielded from what's going on in that arena right now. And the healthy balance sheets that surplus lines companies have built over the years help them weather the storm of the short-term investment market concerns that we saw earlier in the pandemic. So in a sentence, yeah, there are challenges from COVID-19 for the surplus lines companies, but their ability to weather the conditions so far to date really kind of signal that they'll have the ability to overcome concerns in the future.
David, what does AM Best anticipate for the market heading into 2022?
Well, the first thing I'll say is that what we've seen through the first half of the year is that the premium momentum that we saw and the premium momentum that we saw in the marketplace for surplus lines companies has continued through the first half of the year. The 15 surplus lines stamping and service offices produced a report that showed that premiums had increased by almost 22% in that first half. And again, rate momentum is playing a big part in that, because in terms of overall transactions, meaning new policies, renewal policies, and endorsements, the transactions were only up by 7%. So it shows that rate momentum again, where those classes of business, general liability, even umbrella and excess liability, commercial auto to some extent, but again, professional liability and definitely on the property cat side, that's definitely generating continued growth. So I think what we're going to see, from that standpoint, I think we'll continue to see growth. From the performance side, definitely we had, wildfires that were probably struck in different areas out west earlier this year than they might have last year. So I think we have to see how that plays out in terms of the impact that might have had on the bottom line results for any of the surplus lines companies providing property coverage, in some of those states out west. And in addition, we obviously had, most notably Hurricane Ida, but we've definitely had other storm activity that's had an impact on the results so far. So I think we're going to continue to see the momentum, like as I mentioned before, the risk classes and lines of business where surplus lines companies are really coming to the market with solutions. I think those opportunities, they're continuing to seize those opportunities, and so I definitely think we'll see 2021 and into 2022 continue to present those opportunities, and we'll see how that impacts the overall bottom line. But I think the surplus lines market is definitely healthy and has a healthy outlook and an optimistic outlook heading into 2022.
I was Associate Director David Blades and Director Robert Raber. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.